Bitcoin halving expected to happen either today or tomorrow. Top analysts say that the impact is already priced in currently. Bitcoin prices right now, 65,000, moving up even higher. Joining us right now is Matt Hogan. He's a Bitwise Asset Management CIO. Good morning to you. Let's speak about the halving, and let's speak about what you think happens to the value of Bitcoin. Is this a buy the rumor, sell the news situation, or is there something else to think about?
Andrew, good to see you. Glad to be on. I think this is a buy the news event if you pan out long term. You know, if you look historically at halvings, the price action around the halving, if you look out a week or 2 weeks, is relatively muted. But if you look out a year, the Bitcoin price has rallied substantially after each of the past 3 halvings, and I think it will do so again. I think you can overthink this. The amount of new supply of Bitcoin coming into the market is being cut in half. We're removing $11 billion of annual supply. I think big picture, that has to be good for price, and that's what I would expect over the next year.
What do you make of the debate we've been having, and you've probably seen it, hopefully, over the past week, since the retaliatory attack and now this other retaliatory attack overnight? There's been this question about, you know, is it a store of value? Is it a safe haven? What do people do in this moment when there are these geopolitical risks? And what does it say about what the price movement has looked like over the past week and a half?
Yeah, absolutely. You know, there are a lot of cross currents in Bitcoin's price right now. There's ETF demand, there's the halving, there's tax related selling, and of course, there's these geopolitical events. I think you can try to read too much into the short term trading activity. It's better to pan out. If you look big picture, it's done a great job of protecting us against inflation post COVID. I think eventually it will be a good hedge against geopolitical disruptions, but it's a bit too much to ask for Bitcoin to both be a perfect risk-off asset and deliver exponential returns. It's an emerging risk-off asset. When it gets to be fully mature and is a perfect hedge for the events like we saw in Iran and Israel over the past week or so, those exponential returns will be gone. So I think you have to keep that big picture in mind. Bitcoin is still growing into what it will eventually be.
It's also done a good job of protecting the gains that Bitcoin built into the ETF conversions. And so I'm wondering, Matt, you know, a lot of people were already positioning for the next ETF, an ETH ETF, but the VanEck CEO recently said that he thinks that the application will be rejected. What are your thoughts on whether or not that will actually happen? That was the next great catalyst, supposedly, in terms of the next, you know, crypto to see that big run.
Yeah, we have a filing at the SEC right now for an Ethereum ETF, so I can't speak to that specific filing. But I think actually the bigger catalyst is still with Bitcoin itself. The biggest unlock is coming probably in Q3 and Q4 when the major wirehouses turn on access to Bitcoin. So we haven't really even got through the full totality of the Bitcoin ETF launch. I think we will get an Ethereum ETF eventually. I think it'll be, you know, maybe later this year, maybe early next year, and that will be exciting as well. But there's a lot more to come on Bitcoin specifically. There's a lot of reasons to be excited about Bitcoin specifically before we move on to the next thing, which is Ethereum.
Is your sense that it's the ETF where you're going to see most of the action? If you look at what sort of how Bitcoin gets acquired, if you will, by investors, how much of this is going to be the ETF versus the underlying asset, and does it matter?
I don't think it matters, except in the sense that what ETFs have done is they've unlocked the ability for professional investors to access this market. It's very difficult for endowments, for advisors, for family offices to buy buy Bitcoin on an app. It's much easier in an ETF. So I think the marginal new buyers are in the ETF, right? Professional investors control most of the wealth. They've just started being able to access Bitcoin because of this ETF launch. So I think that's where the marginal activity will take place. But of course, you'll see Bitcoin being bought directly as well. Look, Bitcoin is going through both a demand shock from the launch of the ETF and a supply shock from this Bitcoin halving. Those are happening at the exact same time. And that's a really exciting setup for the next year ahead.
Did you catch that CNBC segment discussing Bitcoin's upcoming halving event? It covered some fascinating perspectives from experts who believe this event could send Bitcoin prices skyrocketing in the year ahead. Now let's dive right into unpacking this Bitcoin halving phenomenon. As mentioned in the clip, Bitcoin has a limited and diminishing supply, with new coins released through a process called mining. Roughly every 4 years, the mining reward gets cut in half, hence the term halving. This upcoming halving is highly anticipated because it means the annual supply of new Bitcoin entering circulation will drop from around $11 billion to just $5.5 billion. According to Matt Hoogan, Chief Investment Officer at Bitwise Asset Management, such a drastic supply cut could create massive upward price pressure on Bitcoin over the next year. He cites the bullish price rallies that followed the previous 3 halvings as potential precedent. However, the big question is whether this time will be different, or if the expected price impact has already been priced into the current market. One key factor to consider is the increasing mainstream adoption and interest in Bitcoin from institutional investors. The launch of Bitcoin ETFs late last year opened the floodgates, allowing large investment firms, pension funds, and other professional money managers to easily add Bitcoin exposure to their portfolios. According to Hoogan, this wave of institutional demand combined with the upcoming supply shock from the halving could create the perfect storm for a massive Bitcoin price surge. He likens it to the early phases of the COVID pandemic when both supply and demand shocks rocked global markets. However, not everyone is convinced that the halving will be an automatic buy-the-news event. Some analysts argue that the price impact is already baked into the current Bitcoin prices, which have risen over 65% in the past year alone. They contend that by the time of the actual halving, the market may have already sold the news. This buy the rumor, sell the news phenomenon is a well-documented pattern in various markets, where assets tend to rally leading up to a highly anticipated event, only to experience a sell-off or period of consolidation once the event actually occurs. Interestingly, Hoogan dismisses this concern based on historical price action around previous Bitcoin halvings. He notes that while short-term price movements were relatively muted in the weeks immediately after past halvings, the real fireworks happened in the months and years that followed, with Bitcoin consistently posting massive gains. Of course, past performance is no guarantee of future results, and Bitcoin's path forward is clouded by numerous macroeconomic factors and geopolitical uncertainties. The recent escalating tensions between Iran and Israel have reignited the debate around Bitcoin's role as a potential safe haven asset, or hedge against global turmoil. While Bitcoin has often been touted as digital gold, a modern store of value immune to government influence, its status as a risk-off asset remains unproven. Its price action over the past week, which saw significant volatility amid the geopolitical tumult, suggests that Bitcoin may still have some maturing to do before it can be considered a true safe haven. Another factor that could influence Bitcoin's price trajectory is the increasing competition from other cryptocurrencies, like Ethereum. While Bitcoin remains the largest and most well-known crypto asset, Ethereum has been steadily gaining ground, particularly within the burgeoning decentralized finance, DeFi, and non-fungible token, NFT ecosystems. Hoogan acknowledges the excitement surrounding a potential Ethereum ETF, which could further legitimize the space and drive more institutional capital into cryptocurrencies. However, he believes the real catalyst for Bitcoin in the near term may come from traditional financial institutions finally enabling their clients to invest directly in the asset. Major wirehouses and brokerages have been notoriously slow in providing their customers with access to crypto trading and investment products. As Hoogan points out, it's still incredibly difficult for entities like endowments, family offices, and even many financial advisors to directly purchase and custody Bitcoin through existing channels. The much-anticipated launch of Bitcoin ETFs was a game-changer in this regard, finally allowing professional investors to get exposure to the asset through familiar, regulated investment vehicles. But even with ETFs, many retail investors may still face hurdles or lack of access through their existing brokers and financial platforms. If the major wirehouses and custodian banks can streamline and democratize access to Bitcoin investing for their vast networks of clients, it could unleash a tidal wave of new demand from deep-pocketed investors who have been stuck on the sidelines up until now. Of course, this begs the question, if institutional demand is such a driving force, does the finite supply imposed by the halving really matter? Won't increased demand simply be met by increased mining efforts and an ever-expanding supply? Not quite, according to experts. The Bitcoin protocol is ingeniously designed with a hard-coded supply cap of 21 million coins that can never be exceeded, no matter how many miners join the network. The only way new Bitcoin is created is through the mining process, which requires immense computational power and energy consumption. With each successive halving, the mining rewards are reduced, making it increasingly difficult and expensive for miners to bring new Bitcoin into circulation. This deflationary pressure, combined with the potential for a surge in institutional demand, could create an explosive supply-demand imbalance, the recipe for an unprecedented price rally. While Bitcoin's supply is dwindling, the demand story is only getting more compelling with each passing year. One driving force behind this is the relentless erosion of purchasing power that consumers around the world are experiencing due to rising inflation. In the wake of the COVID-19 pandemic, nations resorted to unprecedented levels of money printing and fiscal stimulus to keep their economies afloat. This massive injection of new currency into the financial system, combined with supply chain disruptions, has resulted in scorching inflation rates not seen in decades. For investors and savers, this insidious rise in consumer prices poses a direct threat to their wealth and standard of living. Traditional hedges like gold have helped, but Bitcoin's unique properties as a truly decentralized, scarce, and borderless asset have piqued intense interest from those seeking to escape the ravages of inflation. Bitcoin's fixed supply cap of 21 million coins means that no government or central bank can arbitrarily inflate or devalue it through policy decisions. Its underlying blockchain technology allows for seamless peer-to-peer transactions without intermediaries like banks. As faith in fiat currencies wavers under the strain of ballooning money supply, an uncorrelated asset like Bitcoin with hard-coded monetary policies is becoming an increasingly attractive value store for both individuals and institutions alike. This growing demand isn't just coming from the developed world either. In emerging markets plagued by rampant inflation, economic instability, and hollowed-out currencies, citizens have been frantically accumulating Bitcoin as a lifeline to preserve their savings. Nations like Turkey, Argentina, and Venezuela have witnessed explosive growth in cryptocurrency adoption in recent years, as locals seek refuge from failed economic policies and crumbling fiat currencies. Even in countries with relatively stable currencies, younger generations have embraced the censorship-resistant and borderless nature of Bitcoin as a hedge against perceived government overreach. This burgeoning global demand from both retail and institutional players is a force that cannot be ignored. When coupled with Bitcoin's ever-dwindling supply post-halving, even modest increases in adoption could trigger a supply squeeze of epic proportions. Of course, any discussion around Bitcoin's future price potential would be incomplete without addressing the environmental impact of its energy-intensive mining operations. Critics have lambasted the flagship cryptocurrency for its staggering carbon footprint and the strain it places on energy grids worldwide. The mining process, which involves a global network of computers racing to solve complex computational puzzles, currently consumes more electricity annually than the entire nation of Argentina. The concentrated geography of mining operations with major hubs in areas with cheap energy like China's Xinjiang region has also raised concerns over their reliance on coal-fired power plants. Proponents argue that an increasing portion of Bitcoin mining is being powered by renewable energy sources like hydroelectric, solar, and wind. They contend that as the incentives crystallize further with each halving, miners will be compelled to seek out the cheapest sources of energy, many of which are renewable. Major mining operations have already established presences in regions with abundant low-cost renewable power, such as Iceland, Quebec, and parts of Texas. Some have even deployed mobile mining rigs directly at renewable energy facilities to minimize transmission losses. Encouragingly, the Bitcoin mining industry has also displayed a willingness to embrace more sustainable practices. Several of the largest mining pools have joined initiatives like the Crypto Climate Accord to accelerate adoption of carbon offsets and green energy solutions. However, even if all Bitcoin mining were to transition to renewable energy sources tomorrow, the sheer scale of electricity consumption remains a point of concern. Simply put, the more Bitcoin's price and hash rate climbs in tandem, the more energy-intensive the mining process becomes. This raises the specter of Bitcoin becoming a victim of its own success. As the digital asset's value and demand grows, so too could the environmental toll of securing its network. Novel solutions are being explored, including more energy-efficient mining hardware migrating to sustainable proof-of-stake consensus models, and even beaming renewable power directly from space. Ultimately, Bitcoin's future sustainability may hinge on a delicate balance between incentivizing decentralization, securing the network, and reining in its carbon footprint. As the blockchain ethos emphasizes, this challenge will need to be tackled through collaborative governance and innovative solutions from all stakeholders. As we've explored, the upcoming Bitcoin halving is poised to be a seismic event that could reshape the crypto landscape for years to come. Whether it unleashes a period of monumental price appreciation or something more muted remains to be seen. What's clear is that Bitcoin finds itself at the intersection of numerous powerful forces: constricting supply, surging institutional demand, escalating inflation fears, and the ever-present tug-of-war between centralization and decentralization. In this heady mix of competing narratives, the only certainty is continued volatility and disruption to traditional financial and monetary systems. Those clinging to the status quo would be wise to keep an open mind to the transformative potential, both positive and negative, that Bitcoin represents. For investors, traders, and speculators alike, the halving presents both tantalizing opportunities and substantial risks. As always, thorough research, risk management, and positioning for multiple scenarios will be crucial to navigating the upheaval ahead. While Bitcoin's future remains fiercely debated, one thing is undeniable: we are witnessing the birth of a new asset class and monetary paradigm in real time. Whether you view it as a revolutionary force for freedom and sovereignty, or a threat to economic stability, the genie of decentralized finance is out of the bottle. How this grand experiment ultimately unfolds is yet to be written, but one thing is certain: the world will be watching the aftermath of this halving event with bated breath. The only question that remains is, will you be along for the ride? That's all for now from InvestMinder. Be sure to subscribe for more insights into the future of money and investing. Until next time, stay safe and keep an open mind.
Thanks again for watching, and good luck with your dividend empire aspirations. Hope you found today's analysis helpful as you look for profitable new stock opportunities. This was InvestMinder. Remember, knowledge equals profit in the stock market. Thanks so much for watching, and please hit that thumbs up button if you got value from this video. Make sure you click to subscribe as well to get our next videos when we reveal the best new insider stock purchases. Invest wisely, trade carefully, and we'll see you next time. Disclaimer: InvestMinder is an independent stock market commentary channel for entertainment and basic informational purposes only. We are not licensed financial professionals and do not provide personalized investing or financial advice. P.S. If you stayed watching until here, you are awesome. Thank you for enabling me to keep making these videos with all the likes and subscribes. Have a great day, and we love you all.